In the public corporation, the entrepreneur no longer reigns. The shareholders, particularly institutional shareholders, have taken the throne. Martin Lipton.
In the United States of America, wealth is primarily built on equity ownership of companies. There are some people who've made money on real estate, but the focus on this video are some of the old and new money families who've acquired their wealth primarily from starting a company that has grown large enough to be public and make them billionaires. The question really is how many of these old money families still own the company that their patriarch founded. I had a conversation with a guest on a previous video where he discussed the idea a lot of the old money families are dying out because they lost control of their companies when they went public. And it motivated me to do some research on how much of the major companies are still controlled by founding families. The question I'm going to go into is how many of these visionary founders or the patriarch of these old money families, the Zuckerbergs, the Musks, the Bezos, the Henry Fords, still actually own or control the companies they built, and how many got diluted or diversified out. Today, we're going to go into deep on how much of the founders actually owned their shares of S&P 500 companies. And the numbers may surprise you. The common academic research on this shows that about a third of S&P 500 companies are family-owned. But when you actually dig into the findings, which I did in this video, it provides a different story. It's approximately 6% to 7% of S&P 500 companies that have material family ownership. And I define material family ownership as holding more than 1% of the stock or controlling the votes of a company, because a lot of these founding families have separate share classes that allow them to have a disproportionate amount of the votes in corporate policy, even if they own a smaller amount of the actual company. And that the 33% number, which is more commonly cited, includes legacy influence, such as the name of the family still being affiliated with the company and them participating in company-related philanthropy activities, but they don't really have any actual influence or control. Among family-controlled companies, 40% of them are still controlled by the founder themselves. Examples of this are very common in big tech companies. You have Zuckerberg at Meta, Larry Ellison at Oracle, Elon Musk at Tesla. 25% are run by second generation, sons and daughters of the founders. An example would be Nike, where Phil Knight is retired and his son, Travis Knight, runs Nike. And then the remaining 35% of family-controlled companies are third generation and beyond. Examples of this include the Waltons at Walmart, Ford family at Ford, the Tisch family at Lowe's, etc. But as the generation goes down and you have more and more heirs as the family expands, as the generations go by, the family loses control for a variety of reasons. A lot of it is just dilution, where you have maybe one kid, but you have 3 grandkids, and then after that, maybe 10 great-grandkids. And if bigger families, that accelerates even faster. So each individual family member's share dilutes quickly over time. Another reason for this is that a lot of the descendant families, particularly third generation or later, really have no interest in being part of the family business or are not qualified to be part of the family business. So they sell their shares or let professional management take over. And then they lose their control through mergers and acquisitions and other things like that. The other thing is, as you go further away from the founder, there's a greater probability that a particular family member's personal finances don't go so well and they're forced to sell their shares. And then there's also diversification. Diversification is often really the smart move here because the probability of a company continuing to exist for 100 years and beyond is quite low. And it's even lower if they're going to continue to have above market returns. So it's actually often way to preserve wealth is to actually diversify away from the core asset that made you wealthy in the first place. And if you are somebody who is a founder or an heir of a founder who has a concentrated position in private or public equity of a single company, my team at Spearhead helps people in those situations assess their current financial standing and then diversify as appropriate to maintain their existing wealth for generations to come. If you want to know more about that, feel free to inquire. The other thing is, in terms of who owns what, let's go more into the specifics. I'm going to name some actual names here. Companies still controlled in the S&P 500 by founders. You've got Meta. Zuckerberg has 61% of the vote, but far less of the company. You have Alphabet. Page and Brin control over 50% of the dual class shares. The Walton family owns 46% of Walmart outright. Phil Knight and his family own 97% of the voting shares, even though they own less than 20% of the company outright. Elon Musk owns 12.8% of Tesla. Buffett owns 14% of Berkshire and over 30% of the vote. The Ford family owns just 2% of the company's stock, but over 40% of the vote. The Lauder family controls 84% of the votes and owns a far lesser share of the equity. Larry Ellison owns over 40% of Oracle. Benioff owns about 2.5% of Salesforce. And the Hearst fortunes is owned by a private trust. They still own a lot of the media companies, but they're private and they're controlled by a trust, which made sure that the ownership stayed in the family. Apple, the Jobs heirs and Steve Wozniak really no longer own material stakes in Apple. Bill Gates owns less than 2% in Microsoft. And the founders of some titans such as Procter & Gamble, Coca-Cola, Pfizer, GE, etc., own little of their shares. There's no founder ownership left, essentially. The Mellon family, who was a big financial family whose name is on the company B1Y Mellon, really no longer has any material shares. The Rockefeller family diversified effectively out of all their oil holdings in 2016. The Morgan family really has no material shares left in Morgan Stanley or JP Morgan Chase. And the Gianninis no longer have any material share in Bank of America. And the DuPont family really has no material share in DuPont or really any of their spin-off companies. So the general trend here is that most of these founders really have effectively no control left of their companies. Even some of the newer money ones, such as Jeff Bezos owns 8.5% of Amazon. Zuckerberg owns only 13% of Meta. There are some exceptions like the Walton family and the Dorrance family, who owns over 40% of Campbell's Soup Company still, and the Nordstrom family, which owns over 44% of Nordstrom. And a lot of privately owned companies is more common because they don't dilute their shareholders by having to go to the public, and lesser liquidity makes it harder to sell, so the temptation to sell is a lot lower. So why does all this matter, and what's the bottom line with the story of founding families and their retained ownership in major publicly traded companies? The bottom line really here is that most founders lose control of their companies by the third generation. And the reasons why this happens, I will elaborate more into a future video, but by then, management is often transitioned to professional management instead of family continuing to operate and run the business. And a lot of the shares are sold either for diversification reasons or dilution reasons or personal mismanagement or a combination of the three. And as a result, a lot of old money families who you associate with starting a company really have no longer any tie or economic gain from that company other than like the prestige and the reputation of being the family that founded the great corporations in corporate America or their equivalents overseas. So there might be a reputational and social benefit, but in terms of economic benefit, founding families don't really have that much left to gain. And even more recent companies, example, like the founders of Apple, the Wozniak family and Steve Jobs' his family have really no material interest in Apple anymore. And that's a more recent story. And if you go further back, it fades even more. And then for investors, there's another reason why this would matter. And just as a disclaimer, nothing in this is investment advice. Please do your own due diligence. But there is research to show, according to Credit Suisse, that companies that have material ownership and have family management and or family ownership of a publicly traded company tend to regularly outperform. They outperform on an average of 370 basis points per year. And the reasons for this is they tend to take a long view, like this is their personal property. They don't really care about quarterly fluctuations in earnings reports, risking their job security if they're more professional management, and CEOs regularly do get fired for missing a few earnings reports. And the turnover for the average publicly traded CEO, I think, is now under 4 years. So job security is not really as much of a risk. They don't really have to care about quarterly results or lumpiness of earnings. They can just care more about the long-term vision, strategy, and capital discipline, which most institutionally managed companies, unfortunately, no longer have that luxury. And so the other reason I think the outperformance gap happens is because the bulk of those founding families are still run by the first or the second generation, which still has the founder's hard edge or the intuitive entrepreneurial capabilities of that founder, and or they were taught well to their founder's children. By the time you get to the third generation, that edge fades and you may just not have the same caliber of talent within the family to manage the company. So that might also explain it, is that this is heavily skewed towards more recently founded companies where the founder or the founder's immediate descendants are still in control. So it's generally a positive for returns, but it might be more of a survivorship bias or other confounding variables than a solid investment thesis in its own right. Let me know what you think about this series. Do you want me to go down more into why founding families often lose control of their companies? Let me know, and I look forward to making more videos like this in the future.